current practice under the board's enhanced prudential standards rule, which generally differentiates requirements that apply to a foreign bank based on the size of the firm's U.S. operations. As an additional difference, the proposals for foreign firms would include 3 categories of standards rather than 4. The proposal for domestic firms included an additional category, Category 1, that would apply only to U.S. global systemically important bank holding companies, or U.S. GSIBs. This category of standards would not apply to any foreign banks. The remaining categories, numbered 2 through 4, would align with the same numbered categories for U.S. firms. Finally, the proposals for foreign banks include an adjustment to one of the indicators used to determine the category of standards that applies to a firm. Specifically, in order to reflect structural differences between foreign banks' operations in the United States and domestic holding companies, the proposals would adjust the cross-jurisdictional activity indicator used for Category 2 to exclude certain intercompany transactions of foreign banks, as was noted. Because the proposals would modify this indicator relative to currently reported data, staff has provided a range of estimates for some firms as to the category of standards that would apply, as shown on the last page of the presentation materials for these proposals. I will now turn to my colleague, Asit Kadia, who will discuss the requirements that would apply under each category of standards.
Thank you, Brian. The proposals would further align the prudential standards for foreign banks to the risks presented to U.S. financial stability, as well as to the safety and soundness of a foreign bank's U.S. operations, and they are consistent with the Economic Growth, Regulatory Relief, and Consumer Protection Act. I will summarize the standards that would apply under the proposals. Following the crisis and as required under the Dodd-Frank Act, the board applied enhanced prudential standards to foreign banks that met specific global asset thresholds, but adjusted the stringency of those standards based on the presence of the foreign bank in the United States. For foreign banks with a more limited presence in the United States, the board largely relied on that firm's compliance with comparable standards in its home country. The proposals today would maintain this approach for foreign banks with a more limited presence in the United States. That is, those foreign banks that meet the relevant global asset thresholds with less than $100 billion in U.S. assets. For foreign banks with $100 billion or more in U.S. assets, the proposals would establish 3 categories of prudential standards that would be consistent with the previously proposed framework for large U.S. banking organizations. I will be referring to the diagram at page 3 of the presentation materials. This diagram details the 3 categories and the standards that would apply under each category. As you can see near the top of the diagram in the row titled IHC, the proposals would maintain the current requirement for any foreign bank with $50 billion or more in U.S. non-branch assets to form a U.S. intermediate holding company. This requirement has resulted in substantial gains in the resiliency and safety and soundness of foreign banks' U.S. operations. The next row of the visual details the capital and stress testing requirements that would apply to U.S. intermediate holding companies of a foreign bank under the proposals. The proposals would largely maintain the stress testing requirements that currently apply to U.S. intermediate holding companies subject to Category 2 or Category 3 standards. For U.S. intermediate holding companies subject to Category 4 standards, the proposals would eliminate company-run stress testing requirements, and these firms would be subject to supervisory stress testing on a 2-year cycle rather than annually. Supervisory stress testing on a 2-year cycle would take into account the risk profile of these firms relative to larger, more complex firms. The next row of the visual details the risk management requirements and single counterparty credit limits that would apply under the proposals. The proposals would significantly simplify the requirements applicable to U.S. intermediate holding companies and align them with the proposal for domestic holding companies. U.S. intermediate holding companies of foreign banks subject to Category 4 standards would no longer be subject to a single counterparty credit limit. This change reflects the lower risk that these firms pose to the financial system. The next page, page 4 of the diagram, which includes proposed liquidity requirements under the proposals. Specifically, the proposals would apply full standardized liquidity requirements, also known as the liquidity coverage ratio, or LCR, and the proposed net stable funding ratio, or NSFR, to U.S. intermediate holding companies of foreign banks subject to Category 2 standards. Like the domestic proposals, these proposals would apply full or reduced LCR and NSFR requirements to U.S. intermediate holding companies of a foreign bank subject to Category 3 standards, depending on levels of weighted short-term wholesale funding, as elevated levels of short-term wholesale funding reflect higher liquidity risk. Finally, for firms subject to Category 4 standards, the domestic proposal did not include standardized liquidity requirements, based on an assessment that these firms generally have more traditional balance sheet structures, are less funded by stable deposits, and have less reliance on less stable short-term wholesale funding. These proposals would amend that approach for both domestic and foreign banks. In developing the proposals for foreign banks, staff observed that some firms that meet the criteria for Category 4 standards have a heightened liquidity risk profile. To address these risks, the proposal would apply reduced LCR and NSFR requirements to both domestic holding companies and U.S. intermediate holding companies of foreign banks subject to Category 4 standards that have $50 billion or more in weighted short-term wholesale funding. I note that currently no domestic holding companies meet this criteria, but certain foreign banks are estimated to exceed this threshold. While the standardized liquidity requirements I have just described would address liquidity risks at the significant U.S. subsidiary operations of a foreign bank, liquidity vulnerabilities also arise at the U.S. branches and agencies of a foreign bank, which could generate significant risks in the United States. The board's enhanced prudential standards rule requires a large foreign bank to assess the liquidity needs of its U.S. operations, including its U.S. branches and agencies, under stress, and to hold a liquidity buffer against projected stress outflows reflecting these firms' idiosyncratic risks. The board's rules under consideration today do not apply standardized liquidity requirements to the U.S. branches and agencies of a foreign bank. Instead, the proposals would request comment on whether to apply standardized liquidity requirements to foreign banks with respect to their U.S. branches and agencies, and possible approaches for doing so in any later proposal. In terms of impact, the proposals would lower capital requirements by approximately $3 billion, or approximately 0.5% of risk-weighted assets under current conditions. Measured over the economic and credit cycle, the impact on capital requirements should be roughly neutral on the levels of capital in the U.S. banking system. The proposed changes to liquidity requirements would represent, in the aggregate, an increase of between 0.5% to 4% in total liquidity requirements for U.S. intermediate holding companies. This increase is largely because the U.S. operations of foreign banks tend to rely on weighted short-term wholesale funding, and the estimated increase in liquidity requirements reflect their increased liquidity risk profile. Staff estimates that most or all firms currently hold sufficient liquid assets to meet these requirements. The requirements would help ensure that U.S. intermediate holding companies maintain sufficient liquid assets under a range of stress assumptions and sustain the safety and soundness of the U.S. operations of foreign banks. Finally, compliance requirements for firms subject to Category 3 and Category 4 standards would generally decrease in line with their smaller risk profiles. This concludes staff's prepared remarks on these proposals. My colleagues and I would be pleased to answer your questions.
Thanks very much. And now we have an opportunity to ask questions of staff, beginning with Vice Chair Clarida.
Thank you, Mr. Chair, and thank you to the staff for really diligent, excellent work on this. Just one question. The statute directs the board to give due regard to the principles of national treatment and equality of competitive opportunity. How does this proposal meet those requirements?
Sure, I can answer that. So by setting a sort of a similar framework as the domestic proposal with some adjustments to reflect the sort of unique structures that foreign banks have in the United States, and using the same sort of risk indicators, we're hoping to set and maintain the competitive equality between foreign and domestic institutions. And in particular, you can see that through the cross-jurisdictional indicator metric and how we're really trying to be quite thoughtful about that.
Great. Thank you. Vice Chair Quarles.
Could you talk a little bit more on this issue of interaffiliate exposures and the reasoning behind the particular proposal of the sort of infinite variety of the continuum one might have on which exposures to include and which not?
Sure. So I think, as you noted in your remarks, the domestic firms, it really is just a third-party measure, and we're mindful that some of that, and trying to align the sort of purpose of the indicator as a measure of complexity and risk with the way that foreign banks operate in the United States. In particular, they do have a number of transactions with their parent, with their affiliate, and so by seeking a middle ground, we're trying to appropriately calibrate that indicator with the risk that we're trying to achieve. And we're seeking and looking forward to comments on that part of the proposal. I don't know if the others know.
Senator Bowman?
You mentioned that the proposal would request comment on liquidity requirements for foreign banks' U.S. branches. Can you discuss more broadly our current approach to branch liquidity and how the proposal addresses liquidity risks of foreign banks' branches in the U.S.?
Absolutely. So as I mentioned in my remarks, the U.S. branches and agencies of foreign banks do present liquidity risks. These branches and agencies tend to rely on short-term wholesale funding compared to U.S. banking organizations given their business model and structure. For example, U.S. branches and agencies are limited in their ability to accept retail deposits. Accordingly, the board's supervision regulation of foreign banks' U.S. operations does focus on this risk. Under the board's rules today, large foreign banks with significant U.S. operations are required to conduct internal liquidity stress tests for their branches and agencies and hold a buffer of highly liquid assets based on the results of the idiosyncratic risks, their idiosyncratic results of those stress tests.
Thank you.
Great, thank you. Then, Mike, back to you for our second discussion item.
Okay, thank you, Chair Powell. For today's second item, I will now ask Katie Ballantyne and Jay Schwartz to discuss the proposed changes to the resolution plan rule.
Thank you. As mentioned, I will provide an overview of the proposal that is before the board to revise the resolution planning rule. The Dodd-Frank Act requires certain domestic and foreign firms to submit resolution plans to the board and the FDIC. Resolution plans, commonly known as living wills, describe a firm's strategy for rapid and orderly resolution under bankruptcy in the event of material financial distress or failure. The main objective of resolution planning is to mitigate the effects of a firm's failure on U.S. financial stability. The board and the FDIC assess resolution plans and provide joint feedback. Over 5 rounds of resolution plan submissions, significant progress has been made. Firms have modified their structures so that losses will not be borne by taxpayers. Firms have also taken steps to ensure that services used by legal entities across the group would continue to be provided through resolution. The proposal accounts for changes to the resolution planning requirement made by the Economic Growth, Regulatory Relief, and Consumer Protection Act. The proposal also builds on the board and FDIC's experience the past 7 years implementing the requirements and tailors application based on firm size, complexity, and scope of operations. This is a joint proposal with the FDIC, and board staff worked closely with FDIC staff in its development. I will begin by introducing the resolution plan filing groups and frequency of future submissions. Jay Schwartz will then explain the content of resolution plan submissions. The proposal would place some firms on a 2-year submission cycle and other firms on a 3-year cycle. The longer filing cycles would allow sufficient time for the development of feedback and for the firms to incorporate the feedback in their future submissions. The proposal also includes 3 types of resolution plan submissions: full plans, targeted plans, and reduced plans. Jay will provide more detail on the contents of each of these submissions. I direct your attention to the second page of the presentation materials for resolution plan requirements and to Figure A, entitled Resolution Plan Filing Groups. The first filing group is firms subject to Category 1 standards, the USGSIBs. This is the group of firms in the far left column on the visual. They would submit a plan every other year, alternating between full and targeted plans. The 2-year submission cycle is consistent with current practice. Since the failure of a firm in this group would pose the most serious threat to U.S. financial stability, the proposal would apply the most stringent resolution planning requirements to these firms. The next filing group is domestic and foreign firms subject to Category 2 or Category 3 standards, the middle column on the visual. Like the US GSIBs, These firms' resolution plan submissions would alternate between full and targeted plans. Compared to the U.S. GSIBs, the domestic and foreign firms in this group are generally smaller and engage in less complex activities with a lower systemic risk profile. For the majority of foreign firms in this group, the preferred outcome is a successful home country resolution that encompasses their U.S. operations, not the separate U.S. resolution approach described in their U.S. plan. Accordingly, the proposal would establish a 3-year filing cycle for this group, adjusting the requirements commensurate with firms' resolution risk profile, activities, and resolution strategies. The third group is foreign firms with $250 billion or more in global assets. They would file reduced plans every 3 years. Most of these firms have a limited U.S. presence, in some cases, a single small branch. Staff believes a 3-year cycle is appropriate given the firm's limited U.S. operations and fewer interconnections with other U.S. market participants. The proposal would no longer apply resolution planning requirements to less complex domestic firms with total assets less than $250 billion and risk-based indicators below the Category 1, 2, or 3 thresholds. Generally, these firms have simpler legal structures and limited non-banking operations. In reviewing these firms' previous plan submissions, the agencies have not identified deficiencies or shortcomings that required remediation. Similarly, the proposal would no longer apply resolution planning requirements to foreign firms with global assets less than $250 billion, where the firm's U.S. assets are less than $100 billion, and their risk-based indicators are below the Category 1, 2, or 3 thresholds. Generally, these firms' limited U.S. operations are conducted in a branch, which would not be resolved through bankruptcy. Accordingly, resolution plan submissions do not seem warranted given these firms' limited U.S. presence and activities. I will now turn to my colleague Jay Schwartz, who will discuss the content of resolution plan submissions.
Thank you. As Katie noted, the proposal would make several changes to the content of resolution plans. In particular, the proposal would identify 3 types of resolution plans: full, targeted, and reduced. The visual on the 4th page of the resolution presentation materials before you, identified as Figure B, compares the informational content requirements for full and targeted plans. Beginning on the left side of the visual, the first column lists the central components of the public and confidential sections of a full resolution plan. The proposal does not propose any changes to the public section of a resolution plan, which would remain consistent for full and targeted plans. The components specified for the confidential section of a full plan are consistent with those required under our current resolution planning rule, and through numerous plan submission cycles, staff has found that they capture the information needed to evaluate a firm's resolution preparedness. As shown in the second column, targeted plans under the proposal would include a subset of the information that would be included in full plans. Notably, all targeted plans would include information about capital, liquidity, and a firm's plan for executing a recapitalization and resolution. Staff believes that these constitute core elements for assessing the risk that a firm's material financial distress or failure would adversely affect U.S. financial stability, and accordingly, this information would be required to be included in targeted plans. In addition, targeted plans would be required to capture material changes to other aspects of the firm's plan that have occurred since the firm's last submission. Staff believes that the proposal would strike the appropriate balance between burden and ensuring that resolution plans contain up-to-date information by capturing these types of changes. The proposal would also give the agencies the ability to identify, at least 1 year in advance, additional information requirements for targeted plans, which could be used to focus on emerging issues or areas of concern. Moving on from the visual, the proposal would adopt new procedures to facilitate tailoring of informational content. When appropriate, the agencies could modify certain information elements of a full plan, either on their own initiative or pursuant to a public request from a firm. The agencies would have sole discretion to jointly deny any firm request for such a modification. The proposal would also introduce a third category of plans, reduced content plans, to be submitted only by certain foreign banking organizations with a limited U.S. presence. Staff believes that there is less risk to U.S. financial stability from these firms' material distress or failure because they have small or relatively simple U.S. operations. Accordingly, after filing an initial full plan, their periodic reduced plan submissions would only be required to include material changes from their prior submissions and an abbreviated public section. For most of the firms in this group, reduced content plans would be similar to what they currently file. Staff believes several features of the proposal should help to ensure that firms continue to make progress in improving their resolvability and that the agencies continue to receive appropriate information regarding resolution preparedness. For example, the agencies would retain the authority to jointly require interim updates between filings or more frequent submissions from firms. The agencies could also require a full plan submission when a targeted or reduced plan would otherwise be required. And the proposal would require firms to provide the agencies with notice of certain extraordinary events, such as mergers, that occur between submissions. In addition to the changes to filing frequency and plan content that we have described, the proposal would also make certain procedural changes to the provisions of the rule regarding critical operations. Collectively, these changes are intended to help ensure that critical operations designations remain up to date and increase transparency around the agency's critical operations designations. That concludes our overview of the changes that would be included in the resolution plan proposal. My colleagues and I would be pleased to answer any questions you may have.
Thanks. Any questions for staff on the resolution plan proposal?
So let me ask, on these new procedures, an institution could request for a full plan that certain of the requirements other than those included in a target plan could be waived. And that requires both agencies or only one agency to deny it?
So that would, that request would be granted unless both agencies jointly deny the request.
So they'd both need to proactively deny in order for that not to be approved. And is that available to GSIBs as well as institutions greater than $250 billion?
It is.
Thank you.
Great. If there are no further questions, then we now have an opportunity for board members to state their position on the proposals. We'll start with Vice Chair Clarida.
Thank you, Mr. Chair. I'm in favor of both proposals. The notices of proposed rulemaking on revised prudential standards for foreign bank organizations and on amended resolution planning requirements. And I look forward to reading the public comments on these notices. Thank you.
Thanks. Vice Chair Qualls.
Thank you, Mr. Chair. I am in favor of the proposals. I gave my thoughts at length at the beginning. I think the only thing that I would want to reiterate here is, like Vice Chair Clarida, I think we should be, this notice and comment process in general with respect to all of our regulatory proposals is something that I think is very important, and that this is the beginning of the process as opposed to the end of the process, and that we're very much looking forward to input on all aspects of the proposal.
Thanks. Governor Brainerd.
Thank you, Mr. Chair. I appreciate the work that's gone into the proposed rules. I've consulted closely with my colleagues in the hope that we could achieve some balance in these proposals. Unfortunately, in my assessment, the proposals go beyond the requirements of S2155 and weaken important safeguards, including for banking institutions with total assets above $250 billion at a time when large banks are comfortably meeting the post-crisis requirements, providing ample credit to the economy, and enjoying robust profitability. Let me start with the proposal to modify prudential standards for foreign banking organizations. Foreign banks responded to the enhanced prudential standards we put in place following the financial crisis by decreasing the risk of their operations in the U.S. and strengthening capital, liquidity, and risk management at the U.S. holding company. And I saw this as important progress. In the crisis, we saw that the combined U.S. operations of foreign banks can pose important risks, as was discussed here today, to U.S. financial stability because of their reliance on dollar-denominated short-term wholesale funding from the U.S. to fund the parent's global activities. That's why the board stated its intention to implement a liquidity coverage ratio, an LCR standard, for the combined U.S. operations of foreign banks when we finalized the LCR rule for domestic banks in 2014. Today's proposal does not achieve that commitment. While it applies liquidity requirements to the intermediate holding companies of foreign banks, the proposed rule doesn't apply liquidity standards to the U.S. branch and agency networks of foreign banks, even though they rely roughly twice as much on short-term wholesale funding as the IHCs. Most U.S. branches serve as important sources of dollar funding for activities at their foreign parents and rely heavily on runnable short-term wholesale funding. As a result, they can face significant run risk at times of stress. This risk is relatively unique to U.S. financial markets, as Vice Chair Quarles remarked, due to the special role of the dollar globally. Leading into the crisis, dollar lending from U.S. branches to their foreign parents grew to very high levels, and it's important to remind ourselves that during the crisis, foreign branches were among the most active users of discount window borrowing. We've long discussed addressing this vulnerability by proposing the application of standardized liquidity requirements to the branches and agencies of foreign banks. This would reduce the incentives to shift assets to branches from IHCs, which is important in light of the fact that branch assets have grown as a percentage of foreign bank activities in the U.S. since the IHC requirements were put in place. I'm disappointed the proposal today does not address the important outstanding liquidity risk at the branches. Turning to the proposal to reduce resolution planning requirements, we saw clearly in the crisis that the failure of one or more large banking organizations may lead to severe stress in the financial system as fire sales and run dynamics spread contagion. The Dodd-Frank Act requires firms to develop resolution plans that provide a credible path to orderly resolution in bankruptcy to ensure taxpayers will not again be on the hook. I support some reduction in the frequency of plan submissions to temper the substantial work entailed. However, today's proposal goes beyond the requirements in ways that may leave the system less safe. It would allow even the largest and most systemic firms to obtain a waiver for many elements of their full resolution plan if only one agency fails to proactively disapprove that request. Under the proposal, banks with $250 billion to $700 billion in assets would require a full resolution plan only once every 6 years, and most domestic banking organizations in the range of $100 to $250 billion in assets would no longer be required to file a resolution plan at all. It's important to remind ourselves that it isn't only the failure of the largest and most systemic firms that pose a risk to the financial system. During the crisis, the failures of large banks in the $100 to $250 billion asset size range necessitated distress acquisitions, and the failure of a large banking organization with roughly $300 billion in assets triggered substantial spillovers. These episodes would have led to rapid depletion of the deposit insurance fund had those institutions not been acquired in distress, an avenue that is less likely to be available today. On balance, therefore, I can't support the proposals. Thank you, Mr. Chair.
Thank you. Governor Bowman.
Thank you, Mr. Chairman. I also appreciate the work the staff has done on these proposals. I support the objectives of maintaining a strong and stable banking system, providing strong protections for financial stability, promoting a level playing field across the U.S. and foreign firms, and aligning requirements that apply to firms with the risks they pose to the financial system. I believe these proposals meet these broad goals. It's very important that we keep the highest standards and requirements for the very largest of banks, and I'm pleased to see that this proposal does that. I also think staff has done a great work to align our standards under this framework with the risk posed by foreign banks. That strikes me as sensible. And as staff noted, FBOs bring important competitive and economic benefits to U.S. consumers and businesses. How we treat liquidity at branches will be very important. So I'll look forward to seeing comments on how we can do that most effectively. I'm in favor of supporting and moving forward with these proposals.
Thanks very much. Thanks to everyone for your comments. I, like others, am very much looking forward to hearing the comments for how we can improve on these approaches that we're considering and on the other topics raised today, in particular the treatment of liquidity at branches and agency, as others have discussed. I think the proposed refinements to our framework for foreign banks are thoughtful and targeted and enhance the risk sensitivity of our rules without changing the overall resilience of the U.S. financial system. They also help lay out a fair playing field in keeping with our principle of national treatment. So I, too, will vote in favor and look forward to the comments. And we will now begin voting on the proposals. First, on the FBO tailoring proposal, I need a motion to approve a proposed rulemaking that would establish a revised framework of prudential standards for large foreign banks, as well as make limited revisions to the proposed prudential standards for large domestic holding companies. A joint proposed rulemaking that would establish a revised framework of capital and liquidity requirements for large foreign banks, as well as make limited revisions to the proposed requirements for large domestic holding companies, and proposed revisions to regulatory reports and instructions consistent with the foregoing notices of proposed rulemakings, and staff to make any minor or non-substantive changes to prepare the documents for publication in the Federal Register.
So moved.
May I have a second?
Second.
I will ask for votes now,
Aye.
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 and I will vote aye as well. Turning to the resolution, pardon me a second. Turning to the resolution plan proposal, I need a motion to approve a joint proposed rulemaking to revise resolution plan requirements for large domestic and foreign banking organizations, and staff to make minor or non-substantive changes to prepare the documents for publication in the Federal Register.
So moved.
May I have a
Second.
second? I will now ask for votes,
Aye.
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 and I vote aye as well. I want to join others in thanking the staff for your hard work and insight in developing these proposals, and very much look forward to hearing the feedback, as I know we all do. And with that, our business is concluded. Thanks very much.